You believe you're logical, don't you? That when it comes to money, risk, and markets, you're the rational one. You weigh the evidence, you assess the trends, you decide carefully. But let me ask you something deeper. If you were truly rational, why have you ever panicked in a downturn? Or chased a stock because everyone else was doing it? Or doubted yourself when things were quiet, even though your plan was solid? The truth is unsettling. You're not investing in markets, you're navigating a fog. A thick, shifting, deceptive fog, and your instruments lie. Howard Marks, one of the world's most respected investors, once said that the key to survival is not brilliance but clarity and uncertainty. Not conviction, but humility. Not speed, but silence. And that's why the metaphor isn't flying through blue skies. It's a submarine beneath the surface. Imagine you're the captain. You can't see far. Your sonar pings but doesn't tell you everything. You rely on instinct, experience, and awareness of the unseen. And the moment you trust what you see too much, that's the moment you hit the reef. This is not a guide to making millions overnight. This is the real playbook for staying alive in a market that punishes arrogance and rewards quiet wisdom. These 20 insights are not about domination. They're about survival. And if you've ever lost money, panicked during crashes, or felt like others knew something you didn't, this is your redemption arc. Welcome aboard. This channel is where real investors come to breathe underwater. You don't need to see the future. You just need to stay alive long enough to win. You think the market is about being right, but it's not. It's about being right, in a way others aren't. Most people believe success in investing means predicting what's going to happen. But Howard Marks flips that completely. He says it's not just what you think, it's how differently and more accurately you think it than others. That's the secret of second-level thinking. Imagine you're in a dark, silent submarine. You pick up a faint sonar signal. First-level thinkers say, there's something out there. Second-level thinkers ask, is it an enemy or a decoy? Is everyone else reacting to this? Should I go toward it, or am I being lured? That pause, between signal and decision, is where survival begins. Second-level thinking isn't about complexity for complexity's sake. It's about seeing the second wave while others are reacting to the first. When everyone's buying because they think a stock will go up, you're asking, is it already priced in? When others panic and sell in fear, you're asking, is this fear exaggerated? Is value still intact? The average investor sees light and thinks safety. The second-level thinker asks, what's beneath that glow? Let me tell you a story. In the early 2000s, during the dot-com bubble, tech stocks were soaring. Everyone wanted in. And yet, Warren Buffett didn't touch them. People called him outdated, even foolish. But Buffett wasn't trying to ride the first wave of excitement. He was calculating the second wave of consequence. And when the bubble burst, he emerged untouched while others drowned. That's second-level thinking in action, questioning the crowd when it's most seductive to join them. What Marx is really saying is this. Markets aren't just a contest of knowledge, they're a contest of perception. And unless your perception is sharper, you'll end up copying moves without knowing the game. In today's world, 2025, where hype spreads in seconds and everyone thinks they're informed, this mindset is more vital than ever. AI-driven forecasts, Reddit trends, and TikTok stock picks have made surface-level thinking louder, not better. In this noise, your edge is no longer access to information. It's how you interpret it. Have you ever made an investment decision just because it felt urgent, only to regret it later? That's first-level thinking. But what if from now on, you paused? You looked deeper. You asked, what is everyone missing? What if you stopped reacting and started listening, beneath the noise? You trust your instruments. You think the data tells the truth. But what if the very tools meant to guide you are the reason you're getting lost? In the world of submarines, sonar is everything. It gives you echoes of the world beyond the fog. But echoes can deceive. A shoal of fish can sound like a mountain. A silence might hide a storm. And in investing, that's exactly what the myth of market efficiency does. It convinces you that the signals are always right. The efficient market theory tells us all information is priced in, that every opportunity has already been discovered, that there's no point searching for bargains because everyone sees what you see. But if that were true, how do crashes happen? Why do bubbles burst? Why did the 2020 COVID crash create so many underpriced companies? And how did some investors know to dive in while others ran? Howard Marks warns us, efficiency is real, but it's not absolute. Markets are sometimes efficient, often inefficient, and always emotional. And like sonar, their signals, the danger is in assuming they're always perfect. Let's rewind to March 2020. The world went silent. Economies froze. Markets tanked. Airlines, hotels, the sonar screamed, danger. But a few investors understood the difference between temporary noise and permanent damage. They knew the sonar was reacting emotionally, not they bought while the panic echoed. And by the time the surface cleared, they had already moved forward. Marx reminds us that sometimes the price of a stock reflects not reality, but emotion, fear, euphoria. In 2025, this is more dangerous than ever. Algorithms trade faster than thought. Headlines trigger chain reactions. One misread signal, one false echo, can cause Your job isn't to react to the sonar. It's to interpret it, to ask, is this real? Or just noise bouncing back from someone else's fear? Think about your last investment. Did you buy because something was truly undervalued? Or because everyone was talking about it? Did you sell because value changed? Or because the chart dipped and your gut clenched? Have you ever trusted a signal too much, only to realize it was just a reflection of someone else's mistake? What if, from this point forward, you didn't just react to what the market shows you? What if you began to listen beyond the echo? What if you made decisions based on preparation, not prediction? It glows, it shines, it moves fast, and it promises riches. But that brightness in the distance? It could be the glow of gold, or the flare of a burning ship. In investing, most people move toward whatever sparkles. A rising stock, a hyped trend, a line on a chart that points upward. But as Howard Marks warns, price is not value. And chasing price is like steering your submarine toward a flashing light without asking if it's a rescue flare or a distress signal. This illusion of light has led more investors into ruin than any storm. Because price is visible, it seduces. It makes you believe something important is happening. But value? Value is silent. It's buried deep under layers of uncertainty, numbers, and patience. The market may double the price of a stock in a month, but that doesn't mean the business underneath is twice as good. It only means more people believe in the light. Let me show you what that looks like in real life. In 2023, Nvidia's stock exploded. AI was the word of the year. Everyone wanted a piece. Price surged like a flare shot into the night. Some said, it's the future. Others whispered, it's a bubble. And here's the key, both were right. The company had long-term value, but the price outpaced it. Those who jumped in blindly got burned in the correction that followed. But those who understood the difference between temporary hype and enduring value, they surfaced stronger. Marx teaches us that value investing is like navigating by depth, not light. You don't follow the shiny objects, you map the ocean floor. You ask, is this business truly worth more than its current price? Or are we all just responding to surface noise? Price can change in an hour. Value, almost never. In 2025, this confusion is even more dangerous. Social media lights up stocks in seconds. TikTok experts turn obscure companies into overnight sensations. But just because everyone is swimming toward the light doesn't mean there's land ahead. It might be a reflection on the water. Or worse, a fire consuming the last ship that went too fast. So ask yourself, have you ever been drawn to a glowing stock, only to watch it collapse after the hype faded? Have you ever mistaken movement for meaning? From now on, what if you made a vow? To chase depth, not brightness. To ask every time you see a price spike, what's the real value beneath this? The water is calm. The sun glistens on the surface. Your instruments report nothing unusual. You feel confident, even a little proud. You've made it through the storm. But that's exactly when it happens. A sudden jolt, the screech of metal against stone. And just like that, you're sinking. Not because of what you saw, but because of what you didn't. This is how real risk works. Not as volatility. Not as red numbers flashing on a screen. But as the quiet, hidden threat that slices through you when your guard is down. Howard Marks says it plainly. Risk is not volatility. It's the potential for permanent loss. Yet most investors continue to treat them as the same. They see a stock drop 10% and panic. But they ignore the company with weak fundamentals sitting quietly at a high price, like a reef hiding just below. You remember Archegos Capital in 2021? They were making massive leveraged bets behind the scenes. No one saw it. The market didn't flash a warning. But when the pressure built too high, one wrong move exposed everything, and $20 billion vanished. There was no volatility leading up to the crash. The risk was invisible, quietly compounding. Just like a reef under smooth waters. Marx teaches us to redefine how we see risk. Volatility might sting, but it's temporary. True risk is permanent damage, losing capital you can't get back. It's buying the wrong thing, for the wrong reason, at the wrong price. And it's thinking you're safe, when you're not. In today's market, this is more urgent than ever. 2025 is a world where assets are tokenized, where hype cycles explode in 24 hours, and where AI-generated optimism can mask fatal flaws in seconds. The surface has never been noisier, but underneath, the risks are sharper, more invisible, and far more deadly. Ask yourself, have you ever avoided a volatile asset that recovered, only to invest in something stable that collapsed without warning? Have you confused quiet with safe? What if from now on, you measured risk not by price movement, but by consequence? What if your question changed from, how much could this swing, to, how much could I lose forever? You don't notice a tide by watching the waves. You feel it in the pull beneath your feet. It's silent, invisible, and unstoppable. One moment, you're standing on solid ground. The next, you're drifting, without realizing you've been moved. That's how market cycles work. And unless you develop the intuition to feel the shift, you're not investing. You're floating, hoping. Howard Marks built his reputation on understanding cycles, not predicting them, but respecting them. Because cycles aren't clocks. They don't tick on schedule. They swell. They retreat. Most investors ignore this. They focus on the present, as if it's permanent. But the tide is always turning. What feels like safety today may be the setup for disaster tomorrow. Take the housing bubble of the early 2000s. The tide of easy credit, rising home prices, and euphoric belief made people feel invincible. But beneath the optimism, pressure built. Subprime loans stacked like sandcastles. And when the water shifted, it wasn't a crash. It was a slow, devastating pull. 2008 wasn't a lightning strike. It was a tide reversal, and those who ignored it were swept away. Marx teaches us to constantly ask, where are we in the cycle? Not with certainty, not with arrogance, but with awareness. In 2025, this question is more vital than ever. Markets move faster now. Crypto crashes in a weekend. AI stocks soar and fall on a whisper. The tide has learned to hide better, but it still pulls. As a submarine captain, you can't see the current, but you can feel it in how your vessel drifts. The pressure, the resistance, the delay in response. It's subtle, but it's there, if you're paying attention. So ask yourself, do you know where we are in the market cycle right now? Or are you assuming this moment will last? Have you made decisions lately based on the belief that trends will continue forever? What if instead you developed a habit, not of forecasting the exact future, but of sensing the pressure beneath? It's not the loud crashes that sink most investors. It's the quiet thoughts that slip in unnoticed. The whisper that says, everyone else is making money. Why not you? Or the silence after a market dip that mutters, Maybe it's all about to fall apart. These aren't charts or signals. They're not data. They're emotions, disguised as logic. And they're more dangerous than any external event. Howard Marks insists that one of the greatest risks in investing is not market volatility. It's you, your fear, your greed, your urge to conform, your impulse to flee. The real battlefield isn't the economy. It's your psychology, because while the market is unpredictable, your emotions are predictably destructive if left unchecked. Picture a submarine again. You're deep underwater. The world outside is silent. Your sonar picks up nothing. But your crew starts to panic. One says, "What if we've gone too far?" Another whispers, "We should turn back." The pressure rises. Not from the outside, but inside your own hull. That's what emotions do. They distort perception, collapse discipline, and steer you straight into danger. Remember the meme stock frenzy of 2021? People poured savings into GameStop and AMC not because of value, but because of fear of missing out. Forums became echo chambers. Hold the line turned into gospel. But underneath it wasn't strategy. It was anxiety masked as conviction. Some made fortunes. Many lost everything. Not because of markets. In 2025, this risk has evolved. AI-generated content floods your feed. Every second you're shown what others are doing, what they're buying, selling, celebrating, regretting. It's no longer your portfolio under pressure. It's your identity. And that's when the inner voice becomes a roar. Marx teaches us to silence that roar with self-awareness, to develop what he calls psychological immunity, the ability to see your thoughts without obeying them, to feel fear but act with clarity, to sense greed but anchor to logic. Because the investors who survive aren't those who feel nothing. They're the ones who feel everything but stay centered. So, reflect. Have you ever made a trade because you couldn't stand feeling left behind? Or sold something, not because it made sense, but because the silence was too loud? What if from now on, you treated your emotions like ocean currents, not something to follow, but something to correct for? He doesn't shout, he doesn't argue, he doesn't show off his portfolio. While the world screams, he listens. While the crowd buys, he watches. And when everyone panics, he whispers, "This is it." The contrarian investor is not a rebel without a cause. He's a silent navigator, tuned to signals others ignore. And in the fog of finance, his quiet may be the loudest truth of all. Howard Marks says it clearly. To beat the market, you must behave differently from the crowd. But not just differently, correctly different. That's the razor's edge. Being contrarian isn't about always saying no or betting against hype just to be clever. It's about stepping back and seeing the emotional currents carrying everyone away, and asking, what are they missing? It's easy to say you're a contrarian when the market is calm, but the test comes in storms. Picture March 2009. The financial system was in freefall, banks collapsing. Fear everywhere. The S&P was down over 50%. And yet, a few investors stepped in, not recklessly, but intentionally. They bought undervalued businesses not because they knew the bottom, but because fear had created price-value gaps so wide, it was irrational not to. Those were the quiet ones. While others clung to lifeboats, they dove beneath the surface and found treasure. Being contrarian requires two things: conviction and patience. You must be willing to stand alone for a while, to be told you're wrong, to watch others win faster. But Marx reminds us, fast money often disappears faster. Enduring wealth is built slowly, uncomfortably, and usually in solitude. In 2025, contrarian thinking is harder than ever. Algorithms reinforce trends. Platforms reward conformity. But the deeper the herd moves in one direction, the more likely the value lies in the other. So ask yourself, have you ever gone along with a trade because everyone seemed to be doing it? Have you hesitated to act because no one around you agreed? What if from now on, you saw disagreement not as a warning, but as a clue? There's a strange truth in investing. The more people search in one place, the less likely there's anything left to find. The crowd looks where the light is. But the real treasure, it's always hidden in the dark, discarded corners. That's where bargains live. And Howard Marks believes finding them is the quiet superpower of those who understand true value. A bargain isn't just a low price. It's a mismatch, a disconnect between reality and perception. The kind of mismatch that only shows itself when fear, laziness, or prejudice cloud everyone else's vision. And the moment you train yourself to look there, to navigate into that fog, you'll discover something few investors ever do. Not every cheap asset is broken. Some are just forgotten. Think back to 2008. Amid the carnage, Howard Marks and his team began buying debt from companies others had abandoned. Bonds priced like they were worthless. Loans no one wanted. But Marks didn't buy because he knew the bottom. He bought because the price-value gap was massive. It wasn't a bet. It was a recognition. Panic had blinded the market, and where others saw wreckage, he saw reward. In 2020, we saw it again. Travel, energy, cruise lines, written off. But buried under fear was something profound. Not every airline was going bankrupt. Investors who looked beyond the panic, who studied balance sheets instead of Twitter trends, found bargains that doubled, even tripled, in the years that followed. Marks warns us, though, don't mistake cheap for valuable. Not everything down is coming back. That's why the map isn't enough. You need a compass. The compass is deep understanding of the business, the balance sheet, the environment, the emotion of the moment. It's not just about looking where others won't. It's about knowing why they're wrong. In today's world, that map is harder to read. Everyone has data. AI scrapes headlines. Algorithms find anomalies. But very few understand why an asset is mispriced. The treasure is no longer hidden by a lack of information. It's hidden by too much noise. So ask yourself, have you ever dismissed a company just because it was boring? Have you avoided an asset because it had bad press without looking deeper? What if from now on, you searched where others fear to go, not recklessly, but with preparation and insight? In the world above, stillness is seen as weakness. Hesitation is failure. Doing nothing feels like doing it wrong. But beneath the surface, deep in the realm of the submarine, stillness is survival. It's listening. It's sensing. It's patience honed into instinct. And Howard Marks believes this may be one of the most underappreciated skills in investing, the discipline to wait. Most people feel they must always be doing something. Buy this, sell that, rotate sectors, chase trends. But Marks teaches the opposite. Sometimes the most profitable action is strategic because the greatest opportunities don't come every day. They emerge in rare, volatile moments, and if you're always moving, you'll miss them or be too exhausted to act. Think of a hunter in a dense jungle. He doesn't charge blindly through the trees. He waits, observes, blends into silence. And when the time is right, that's the investor Marks trains you to become. One who doesn't confuse activity with progress. Consider Seth Klarman of Baupost Group. Known for taking massive cash positions during periods of overvaluation, Klarman once held over 50% of his fund in cash. Critics mocked him, but when markets crashed, he was ready. While others were scrambling, he was buying. Not because he predicted the crash, but because he waited. In 2025, this lesson is harder than ever. Broker apps gamify trading. Social feeds make inaction feel like stupidity. There's always a coin pumping, a stock trending, a narrative demanding urgency. But here's the truth. If you're always reacting, you're never preparing. Stillness is not passivity, it's positioning. It's knowing the fog will shift and choosing to conserve energy until it does. Marks compares it to sitting at the poker table. You don't play every hand, you fold, you wait, you conserve your chips for the moment that counts. The amateurs chase action, the pros wait for edge. So ask yourself, have you ever acted just to feel in control? Made a move because silence felt unbearable? What if, from now on, You redefined stillness, not as fear, not as laziness, but as an edge, a choice. What sinks ships isn't always what's seen. It's what lies in the uncharted water, the trench you never expected, the current you didn't feel. And the same is true in investing. The biggest danger isn't what you know is risky. It's what you don't know. Howard Marks calls this the role of ignorance, and he treats it not as an insult, but as a survival principle. Most investors pretend they're in control. They study, analyze, build models, and believe they've accounted for every variable. But this overconfidence is a trap. The market is a living, shifting organism, constantly reacting to factors no one fully sees. Black swans don't come with schedules. Risks don't knock before they enter. The illusion of certainty is what creates disaster. In 1998, long-term capital management collapsed, despite having Nobel Prize-winning economists at the helm. Their models, and yet, they didn't account for what they couldn't imagine. In just weeks, $4.6 billion vanished. Why? Not stupidity. Not lack of knowledge. But the blindness that comes from believing you're too smart to be blindsided. Marx urges us to develop humility, to constantly ask, what am I missing? What assumptions am I not even aware I'm making? In submarine terms, it's the depth you didn't measure, the pressure you assumed wouldn't build, the sonar blind spot you forgot existed. In the 2020s, this challenge has intensified. We have more data than ever, yet also more false confidence. AI tools give predictions with confidence levels that feel scientific, but are often just refined guesses. Retail traders access complex instruments they don't fully understand. And platforms reward boldness over caution. That's why Marx believes the smartest investors aren't the ones who know everything. They're the ones who know they don't. They hedge, they prepare, they build margin for error. They act like submarine captains navigating a trench they can't fully map. So, reflect. Have you ever felt certain about a trade, only to be blindsided by something you never considered? Have you ever ignored the unknown because acknowledging it made you uncomfortable? What if from now on, you treated uncertainty not as a nuisance, but as your co-pilot? Before a submarine hits the wall, there's often a whisper, a faint echo off the steel, a subtle shift in water pressure, a delay in response time. It's not loud. It doesn't scream. But for those who've been here before, it's unmistakable. It says, you're getting too close. In investing, that echo is the rhythm of the market cycle. And Howard Marks believes one of the most important survival skills is developing a sense of where you stand in that rhythm. The market moves in cycles, bull and bear, optimism and fear, expansion and contraction. But most investors don't act as if it does. They treat the present moment like it will last forever. When prices rise, they believe the sky is the limit. When panic hits, they think the bottom is infinite. This blindness to cycles is why fortunes are made and lost, not during the booms or busts, but in the turns. Marx doesn't believe you can time the market with perfection, but he's adamant that you can read the signals. Not to predict the day of the crash, but to sense when risk is high and reward is low, and vice versa. It's like knowing the difference between shallow waters and a trench, even if you can't see the bottom. In 2006, housing prices were soaring. Everyone believed the cycle had been tamed. This time is different, they said. But the echo was already there. Easy credit, speculative flipping, rising debt. Those who had learned to listen, who felt the cycle had stretched too far, quietly reduced exposure. They weren't prophets. They were simply attentive. Marx teaches that every cycle has patterns. Surges of euphoria, denial of risk, overconfidence, and then the inevitable contraction. And you, as an investor, must always not to guess the exact top or bottom, but to adjust your depth, your pace, your risk tolerance. In 2025, this matters more than ever. The economy is volatile. AI optimism runs high. Tech bubbles inflate faster than in any previous decade. But beneath that enthusiasm, the echo grows. Rising debt levels, geopolitical tension, valuation extremes. Can you hear it? Have you ever invested in something because everyone was, and then felt blindsided when it turned? Have you ever ignored your gut telling you it had gone too far? What if from now on, you made it a habit to check the cycle, not just the chart? You planned it perfectly, ran the numbers, checked the fundamentals, watched the timing, and still, it didn't work. Or maybe you winged it, followed a hunch, took a wild shot, and somehow it paid off big. In both cases, you might think your result was skill. But Howard Marks reminds us, luck is always in the room, whether you admit it or not. Luck is uncomfortable. It threatens the story we tell ourselves, that success came from brilliance and failure from a flaw. But in investing, randomness plays a silent but massive role. You can make the right decision and still lose, or make a poor one and win. That's what makes the game so dangerous and so humbling. Take Bill Ackman, the legendary hedge fund manager. In 2020, just before the COVID crash, he bought credit default swaps, essentially betting that corporate debt would collapse. Within weeks, his $27 million position turned into a $2.6 billion profit. Was he smart? Yes. Was he lucky timing-wise? Absolutely. If markets had delayed their drop by even 2 weeks, the result might have been drastically different. Marks doesn't deny skill, but he warns against worshipping outcomes. Because when luck is involved, outcomes lie. That's why he emphasizes a good decision can lead to a bad result and still be right. A bad decision can work out and still be wrong. The goal is not to win every time. The goal is to make decisions that would be right over time. In 2025, this lesson is vital. With so many influencers, algorithmic trading apps, and performance snapshots going viral, it's easy to idolize outcomes. But what you see is only the visible part of the iceberg. Beneath every win is a swirl of randomness. And if you confuse luck with mastery, you build on sand. This is where ego becomes fatal. When a lucky streak convinces you you're invincible, you begin to risk too much. Push too hard. Ignore warning signs. And that's when the market humbles you. The ocean always does. So pause. Have you ever felt like your success proved you were better than others? Or felt like a failure because a smart decision went south? What if you started measuring your quality not by the result, but by the reasoning? You may not see it, but the smartest investors wear armor, not flashy suits of bravado, not the polished shields of predictions. Their armor is quiet, nearly invisible. It's made of doubt, not paralyzing fear, but strategic caution. Howard Marks calls this mindset defensive investing. And in a world obsessed with gains, it might be your only chance to stay alive. Defensive investing isn't about hiding in a bunker. It's about assuming the world is unpredictable and preparing for that chaos. It's understanding that survival is the first rule of the game, because if you lose too much too fast, there's no next round to play. Imagine a submarine heading into uncharted waters. The captain doesn't say, "Let's go full speed." He says, "What don't we know? What could go wrong? Do we have enough oxygen? Can we turn around if we have to?" That's the language of defense. It's not glamorous, but it keeps you alive. Marx emphasizes margin of safety, buying assets below intrinsic value, holding cash when opportunities are scarce, avoiding leverage that could explode. You don't get headlines for that. You don't trend on social media, but you last. And in investing, lasting is... Let's look at Japan. In the late 80s, the Nikkei was at 38,000. Euphoria ruled. Real estate in Tokyo was worth more than all of California. Investors chased the dream. Then, collapse. The market didn't recover its peak for over 30 years. Those who were aggressive, leveraged, and exposed, they vanished. Those who were patient, cautious, in today's environment, 2025, defensive investing is more essential than ever. The world is volatile. AI bubbles, crypto euphoria, debt levels soaring. Defensive investing doesn't mean avoiding all risk. It means choosing which risks are worth facing and which aren't survivable. Howard Marks doesn't celebrate boldness. He celebrates prudence. You don't make money when you buy. You don't make money when you sell. You make money by how well you handle risk. That's the silent truth few acknowledge. But it's the truth that separates a short-term trader from a long-term legend. Ask yourself, are you investing to impress others? To feel smart? Or to quietly, patiently build wealth that survives cycles? Have you ignored defense because offense felt more exciting? What if, starting now, you added just one layer of caution to every decision? What if you didn't ask, how much can I gain? But, what could I lose, and can I survive it? Not every glowing doorway leads to freedom. Some are traps. Some are illusions designed to feed your deepest desires and then swallow you whole. In investing, these are the pitfalls. The seductive ideas, trends, and shortcuts that promise everything and cost you everything. Howard Marks doesn't just warn about risk, he maps the minefields. Because avoiding loss, he says, is often more powerful than chasing gain. Greed doesn't scream, it whispers. It sounds like, this one's different. You'll miss out. Everyone else is making money. And when that voice takes over, you stop thinking. You stop analyzing. You just move straight into. Take Theranos. Once valued at over $9 billion, the startup was a symbol of innovation. Promises of blood-testing revolution. Big names invested. No one wanted to miss out. But beneath the glossy pitch, there was no product, no substance. Just a story too good to question. Or look at the cryptomania of 2021-2022. Meme coins, NFTs, digital plots of land selling for millions. Logic suspended, greed unchained. And then, implosion. Projects evaporated. Fortunes dissolved. Marx teaches that many of the worst investment decisions are made not in confusion, but in confidence. Overconfidence. The belief that you've figured it out, that this time is different, that you are different. That's when you stop checking for mines, because you believe the map no longer applies to you. In 2025, this is amplified. Social media normalizes wild success. Everyone seems to be doubling their money. Overnight millionaires flood your screen. But what you don't see are the bodies off camera. The accounts blown up, the leverage gone wrong, the lives upended. The minefield is still there. It's just buried beneath better marketing. Howard Marks urges us to build systems that protect against these traps. Ask yourself before every move, is this decision driven by clarity or by fear of missing out? Would I still make this move if no one ever knew I did? Am I being seduced by potential or grounded by probability? Have you ever chased an opportunity that felt too good to be true? Because deep down, you wanted it to be true? Have you ever ignored a red flag because you couldn't resist the glow? What if, from this point on, you assumed every bright opportunity was a test? That your job isn't to sprint through, but to pause, probe, and ask, what danger lies beneath this light? Not all heroes wear capes. Some work quietly in the background, unseen, unheard. They are the silent engineers of the investing world, the ones who add value not by grand gestures or headline-grabbing trades, but by careful, meticulous decisions made over years. Howard Marks admires these investors who build, repair, and strengthen portfolios quietly, avoiding the limelight but delivering lasting results. Think of them as submarine engineers, tuning the machinery, checking every valve, ensuring the vessel runs smoothly even in turbulent waters. Their work is never flashy. It's often tedious, but it's indispensable. Without them, the ship sinks. Consider Warren Buffett's approach. While media highlights his big buys, the real story is in the slow, steady compounding of strong businesses bought at sensible prices. No hype, no rush. Just quiet discipline and relentless focus on value. In 2025, this mindset is increasingly rare. The world rewards noise and speed. Social media celebrates instant gains. But Marx reminds us that real investing is a marathon, not a sprint. It's about controlling what you can, your process, your decisions, your reactions. Silent engineers resist the urge to chase every opportunity. They assess risk continuously. They add value by pruning losses, diversifying wisely, and holding on to quality through storms. Their portfolios may not make headlines, but they survive and thrive where others. Ask yourself, are you seeking quick wins to impress? Or are you building something that lasts? Have you ever ignored the small, steady work needed to protect your capital because it felt boring? What if from today, you embrace the role of silent engineer? Not seeking applause, but ensuring your investing vessel is seaworthy, ready for any storm, any fog. Every submarine captain carries a compass, not just a tool, but a guide that aligns every decision, every turn. In investing, your compass is your strategy, your principles, your self-awareness. Howard Marks stresses that knowing your own limits and strategy is the foundation of long-term success. Without a compass, even the best vessel drifts aimlessly. You may follow trends, mimic others, or chase the latest hot tip, but without internal direction, you lose control. This leads to panic buying and desperate selling, the enemy of discipline. Think of Peter Lynch. He famously stuck to what he understood, investing in businesses he could evaluate with confidence. His compass was clear. Invest in what you know, be patient, and avoid overcomplicating. It guided his decisions through decades of market swings. In 2025, clarity of strategy is vital. The flood of information and noise can confuse and distract. Without your own compass, you risk becoming a puppet to market moods and fleeting trends. Marx says your compass should be personal and flexible. It evolves with experience but is rooted in core principles: risk control, value recognition, and patience. It prevents you from being swept away by the tides or lured by false lights. Ask yourself, do you have a clear investing strategy? Or do you find yourself jumping between ideas? Have you ever followed a crowd only to regret it? What if from now on, you committed to developing and trusting your compass, to navigating with purpose, even when the fog thickens? Even the most advanced submarine has depth limits. Press too deep, and the pressure crushes everything inside. In investing, knowing your limits is the invisible safety valve that keeps your portfolio intact. Howard Marks teaches that overconfidence often leads investors to ignore these limits, pushing into risk zones they don't fully understand until it's too late. Limits aren't signs of weakness, they're markers of survival. It's knowing how much risk you can endure emotionally and financially without losing your way. It's understanding your capacity for loss and resisting the temptation to stretch beyond it for quick gains. Take the 2007-2008 financial crisis. Many firms leveraged themselves to the hilt, believing their models were infallible. When the market turned, they couldn't cope. They breached their depth limits and imploded. Meanwhile, others who maintained conservative leverage survived, and even thrived after. In today's fast-moving, high-leverage world of 2025, depth limits matter more than ever. The temptation to borrow, to leverage, to amplify returns is powerful, but so is the risk of catastrophic loss. Marx encourages investors to self-assess honestly. What is your risk tolerance? How would you react if the market dropped 30% tomorrow? Can you stay calm and stick to your plan? Knowing these limits allows you to navigate safely through the pressure of market swings. Reflect on your own investing. Have you ever taken on more risk than you felt comfortable with, only to panic later? Have you ever ignored warning signs because you hoped for a quick rebound? What if you started respecting your depth limits as fiercely as your goals? What if discipline became your strongest asset? Expectations are like ballast on a submarine. Too much, and you sink. Too little, and you lose control. In investing, Howard Marks warns that unrealistic expectations are one of the deadliest traps. When you expect constant gains, smooth sailing, or perfect timing, disappointment is inevitable, and disappointment breeds poor decisions. Investors often imagine markets as upward escalators, never faltering, always rewarding. They plan their lives around steady returns and painless climbs. But the market's reality is and when reality falls short of expectation, panic sets in. They sell low, buy high, and abandon plans. Consider the tech boom of the late 1990s. Expectations soared to the sky. IPOs exploded. Investors assumed the new economy would never slow. When the bubble burst, those with rigid expectations were crushed. Their shock wasn't just from losses, but from the shattering of their worldview. Marx urges investors to develop reasonable expectations, anchored in history, tempered by humility, and prepared for volatility. It's about expecting storms and being ready to navigate them, not hoping they never come. In 2025, this lesson is crucial. Social media amplifies success stories and hides losses. The perfect trade illusion tempts traders daily. But those who anchor themselves in reality, ask yourself, what expectations do you hold about your investments? Are they realistic? Have you built your plans assuming smooth waters? What if from today, you adjusted your mindset to expect uncertainty, value patience, and accept that losses are part of the voyage? Prediction feels powerful. The idea that you can see ahead, anticipate the storm, and adjust your course gives a sense of control. But Howard Marks reminds us that prediction is an illusion in investing. The market is too complex, too influenced by countless unseen forces. Instead, he champions preparation, the art of readiness. Imagine relying on sonar signals that sometimes lie. You can't know exactly what's ahead, but you can prepare your submarine to handle whatever comes. Reinforce the hull, check the oxygen, have escape routes planned. That's preparation. In 2020, many tried to predict the market's bottom during the COVID crash. Few succeeded. But those who prepared, holding cash, reducing risk, ready to deploy capital when conditions improved, capitalized while others scrambled. In 2025, with rapid market shifts, prediction is riskier than ever. Algorithms try to forecast movements, but black swan events still blindside the unprepared. Marx teaches that accepting uncertainty and focusing on adaptability creates Reflect on your own strategies. Have you placed too much faith in forecasts? Have you been caught off guard by events no model predicted? What if you shifted from trying to see the future to preparing for all futures? What if readiness became your greatest asset? The greatest paradox of investing is that there is no single, most important thing. Howard Marks closes his wisdom with this truth. The market is a living, breathing, shifting sea. What matters most today may be irrelevant tomorrow. Success lies in balance, the blend of insight, humility, patience, and courage. Imagine steering a submarine through the fog with no fixed path. Sometimes you dive deeper to avoid storms. Sometimes you surface to catch the light. Sometimes you drift quietly, waiting for clarity. The secret isn't in one maneuver, it's in mastering the dance between them all. Marx teaches us that investing demands flexibility. You can't cling to one principle and expect it to solve every problem. Instead, you must understand when to apply which tool. Second-level thinking today. Defensive investing tomorrow. Patience, contrarianism, risk control. The right move in 2025, this is more critical than ever. Markets evolve rapidly. Technologies change. Economies fluctuate. The only constant is change. Investors who survive and thrive aren't rigid. They adapt. They listen to the fog, read the tides, respect. So, as you step off this journey, remember, there is no magic bullet, no single rule, just a commitment to learning, humility, and resilience. To navigating the fog with eyes open, mind sharp, and heart steady. Have you been searching for the one thing that will unlock all investing secrets? What if the real answer was embracing complexity, uncertainty, and imperfection? What if the final turn isn't a destination, but a lifelong voyage? This is the most important thing, to keep moving forward, aware, prepared, and unafraid of the fog. You've just navigated 20 depths of investing wisdom, the sonar pings, the hidden reefs, the tides beneath, and the silent battles within your mind. This journey wasn't about quick riches or secret tips. It was about survival, about building the discipline and insight to stay afloat when the storm rages. If these lessons shifted your perspective, drop a comment below. What insight changed how you see the market fog? Share your own stories of navigating uncertainty. Subscribe not for hype, but for clarity. For those who want to last decades, not just moments. For the silent engineers, the patient captains, and the contrarians who listen to whispers rather than screams. Remember this: great investing isn't about predicting the future. It's about surviving long enough to shape it. Thank you for joining this voyage. The fog is thick, but with the right compass and courage, we'll find our way together.